at operating budgets, some more details. So again, we start from sales, right? This is the detailed components of operating budgets that we just went over. Sales, inventory, purchases, cost of goods sold, then operating expenses. Then all of these feeds into a budgeted income statement. So what does a sale budget look like? Looks like this. So see that, let's give you an example. Greg's Tunes Company wants to do budgets for the next 4 months, April, May, June, July. All these sales information, expect that the departments on marketing, advertising, they already have the information and they expect that the company's products is able to sell in the market. This is their anticipated sales dollar amount. Then some of the companies will break it down into detailed components on cash sales or credit sales. So remember that sometimes when you purchase something, especially you and I, if we use credit card, that's also considered not a cash sale. It's also the amount that you're paying later on. Right? So this is accounts receivable to the business. This is credit collections that they sometimes get next month. After they actually sell the products this month, they get the money next month. So the anticipated portion that they're getting for every single month's sales, 60% falls under cash sales, 40% is accounts receivables. However, altogether, the transactions falls under sales revenue. Okay, remember that whenever we journalize entry, whenever there are sales, that happens regardless of cash sales or accounts receivable sales, we still journalize all different types, right? Because accrual accounting, we're not just journalizing cash transactions, we're also journalizing some of the transactions that relates to cash receipt or cash payment later. It's still considered sales. Okay, so altogether, April we anticipate we're selling $50,000 worth of products. Next month, 30,000 more. June decrease 20,000, July 50,000 again. Altogether, we break it down in each and every month, a portion into cash sales, a portion that is anticipated as credit sales. Okay, so overall, at the end, what gets into income statement is this dollar amount, $240,000, adding up all the sales revenue together. So this is an example that a company wants to do budget for all 4 months together. They may also do it for 6 months. It doesn't really have a strict policy on how many months in a budget statement. So that depends on business. But as long as they list the detailed information, at the end, what goes into budgeted income statement is the total sales revenue. So you will see this later at the end when we put together the entire income statement, the first line. Okay, so this is easy, right? Just simply listing the information, what is cash sales, what is credit sales. Now remember that sales dollar amount comes from whatever the number of items that a company is expecting to sell, the amount, and then you time the retail price. Okay, so if it's $10 for each product, 1,000 products, then you have $10,000. So after sales, what links to sales is cost of goods sold and all the inventory related numbers. Right, so budget determines, this area of budget determines at the end what is the total dollar amount of inventory cost, which we call the cost of goods sold. What is the anticipated ending inventory level after your expected sales? What is the dollar amount of purchases that you may need to make after sales entries? Okay, so after selling a portion of the product, turn it into cost of goods sold. You may have a lower level of ending inventory, and then you need to do budgets for next season. What is the potential number of products that you need to purchase, which goes into purchases account. Okay, so this area of the budget, literally just by its name, it determines all three numbers: inventory, purchases value, cost of goods sold. Okay, so this portion of this statement, before we look at a table, links closely to this equation here. So I wouldn't really call it a math equation because really it's just the concept of how inventory flows into the business. Right, you start from last year ending inventory, which is this year's beginning. Then you make purchases. Whatever you sell minus ending inventory will give you cost of goods sold expense. Okay, so this is from financial accounting. We'll also review this a little bit in the beginning of this course. Okay, let's take a look at a inventory purchases cost of goods sold budget. So you can see that the first line here, we start from cost of goods sold, and then that total cost of goods sold amount, the blue highlighted number, 168,000, will also at the end go into income statement. And our income statement starts from sales, which we did earlier in the table. Then minus cost of goods sold, you will get to gross profit. Okay, so that's why we list the first line cost of goods sold here. And usually a company will have certain policies to determine their anticipated cost of goods sold level. So this particular example, they use 70% times whatever sales revenue that they're anticipating to get as the number of 35,000, 56,000, 42,000 each and every month's cost of goods sold. Okay, so what this means is from the previous table, you got the numbers here, right? This $50,000 times 70% will become cost of goods sold budget, $35,000. Okay, for the next month, $80,000 times 70% will become the $56,000 cost of goods sold. So using the same policy for the remaining months. So this is just one example. Companies can also determine it could be 80% of the sales. Then you will use sales revenue times 80% to get cost of goods sold level. Okay, so that's how you get the first line. If you're given sales budget, you're given the policy, 70% of sales, you can just use that to time the previous table to get these numbers. Now, desired inventory, also the same. Companies may set policies. This particular example, they set it as at least they want $20,000 in the warehouse, and then plus 80% of next month's cost of goods sold. So what does this mean? Because we're budgeting this month's ending inventory. It must be something that we have to have left over in order to prepare for next month's sales, right? So they expect that ending inventory level to be at least $20,000 and then plus whatever next month's budgeted cost of goods sold is, 80% of that. Add it all together, this is the policy of how they get to that $64,800. So you will be using $20,000 plus 0.8 times $56,000 to get $64,800 for the first month, April. For May, you'll use $20,000 plus 0.8 times $42,000. Okay, so this is the policy. This will be given to you for each and every problem. What is the policy to determine their ending inventory, their cost of goods sold? So if you have cost of goods sold, you have desired ending inventory, add them together becomes the total inventory required in each and every month that they should have in their warehouse.
What about July? Where would we get the cost of goods sold?
July, then the problem will tell you the future month, what is their expected sales, what is their expected cost of goods sold. That is a great question because here from this table you can't see August cost of goods sold, right? So in the problem, if they want to complete one of these tables, then they'll definitely need to give you what is August cost of goods sold level. Then you can fill it into this, okay? Okay, so the third line here, total inventory required, basically is just adding up cost of goods sold and desired ending inventory for each and every month. Minus beginning inventory will give you at the end the purchases level that the company needs to make in every single month. So purchases meaning that since you're expecting the company to sell cost of goods sold certain level, you're expecting to have stored up ending inventory at a certain level based on the policy, you may need to replenish your inventory, you need to purchase more. So at the end, the last line here, purchases means what is the inventory value that you need to purchase additionally in each and every month. Okay, once again, the logic here goes back to this equation. So how do we get purchases? If you rearrange the beginning equation, beginning plus purchases minus ending gives you cost of goods sold. If you want to get purchases, that basically equals cost of goods sold level plus the ending inventory level minus your beginning inventory. Okay, so this factors in the table here. So again, from this first line cost of goods sold level, the company is budgeting to get at least 70% of sales. So 70% times sales will give you each and every month's expected cost of goods sold value. Second line, their desired policy for ending inventory is having at least $20,000 worth of inventory plus whatever level cost of goods sold is for next month times 80%. So that's how you get the second line, desired ending inventory. Okay, if you add those two together, that becomes the inventory level required for each and every month, the portion that you're either selling or the portion that you're leaving in the business. Add them together becomes the total inventory value. If you minus any beginning value, that will give you the purchases that you need to make for April, for May, for June, and July, that you need to replenish in order to fit May's cost of goods sold, May's ending inventory requirement. All right, are you following? Lost? Thinking about? Okay, so the summary of this, what we're trying to get out of this at the end is that blue number there, $168,000. That will be factored in income statement, because income statement we start from sales, then we minus cost of goods sold. The middle portion here will be used for cash budget at all the other balance sheet budgets, because remember, balance sheet will require inventory level. So the middle portion here later will be transferred to balance sheet. Purchases, we will also need this for budgets, cash budgets specifically, because that relates to the inventory value that you want to get. So you need to pay these dollar amount to purchase this inventory. Okay, so a lot of these budgets information are actually linked together. Just from the first line, you know you'll need to refer to sales in order to get cost of goods sold. From this table, in order to get cash budgets, you'll need to pull some of these information and transfer to cash budget. For balance sheet, you will also need to refer to the ending inventory that you see here, transfer that to the balance sheet. So these budgets, they're not really independent tables. They're actually linked together. All of them factors in the 4 statements at the end. Okay, so we talked about sales, we talked about cost of goods sold, ending inventory, and purchases. Last portion before we actually get to income statement will be all the remaining expenses. So this is only the expense for inventory, right? After gross profit, the remaining expenses relates to utilities, rental, depreciation, right? So all the expenses, these are considered, we just call it the same category, in one category, operating expenses budget. So basically it's the income statement portion, the last portion before you get to net income. You have all the salary, commission expenses, rent expense, insurance on plant, insurance on the store, advertising of products, and all the other expenses that potentially the business will have. As long as it's a temporary account, it's not a long-term asset, it's considered operating expenses. Okay, so the middle part when we do budgets, a portion of these may link to the previous sales table as well, specifically the first 2 lines here. Okay, you may have commission expense, salesperson salary that links to how much sales have been given to customers, have been provided to customers. So you may anticipate commission to be 15% of sales, and you'll need to refer to that table of sales in the first month, $50,000 of sales times 15% to get the anticipated commission expense. So this is the budgeted commission expense. Company also has different policies to calculate these expenses. So it could be 15% or 20% of sales, that depends. But as long as you're given the policies, then you refer to the table to figure out the first line, the second line, and whichever expenses that the problem tells you is based on sales. So based on sales, that makes it a type of variable expense or fixed expense. Variable, because it actually floats with sales. Right, so this also goes back to Chapter 19 when we characterize expenses into either variable or fixed. Right, so the upper portion, variable expenses, when sales goes up, the commission expense goes up, miscellaneous expense goes up. As opposed to that fixed portion here, you can see that it's a recurring amount every single month. Okay, so the bottom ones here for the long-term employees, not part-time ones, perhaps you have certain contracts for their salary As long as they don't leave the company, then the salary expense, we can anticipate that every single year is there. Right, rent expense, also a fixed amount every single month. Depreciation expense, the same amount for these long-term assets. Okay, so the bottom portion here, in order to get to this operating expenses budget, definitely the problem will give you what is the anticipated fixed expenses, what is the variable expenses, and what is the policy for the variable expenses. Then you refer to the sales table to get the first two lines. The middle portion basically is a recurring amount every single month. Now again, if we take a look at the blue lines here, April through July altogether, we may be anticipating commission expense $36,000, miscellaneous $12,000, and the remaining fixed expenses. All of these numbers adding together 4 months will be transferred to budgeted income statement. Okay, so this will be the middle portion of income statement. For each and every income statement, we start from sales, which is the first table that we talked about, sales revenue. Then you have cost of goods sold from the second table. Minus these two, you get gross profit. Then you have all these blue operating expenses, which we break down to variable cost and also fixed cost, or you can say expenses. Okay, so after this, then you get operating income, and if you have expenses or gains in sales, then you have net income at the end. If you don't have any interest expense on this or any gains and losses on planned assets, then these two will be the same. Okay, the first budget table is this. Second, what you're getting is this. Third, you're getting is all the remaining operating expenses.